Hello, everybody. So, a question that I ask myself often is which of the stocks in kind of my coverage universe, which of the stocks is the best buy right now based on valuation? Which is the most undervalued or overvalued? If you were anti growth stocks, you would say which one is the most overvalued? To me, I love growth stocks. And so, which is the most high growth stock, which is the most undervalued high growth stock? And this is kind of like the rationale behind this spreadsheet that I've put together. And in this video, I want to walk you through the numbers in the spreadsheet and kind of answer that question is like, out of all of the growth stocks, which one is the most undervalued right now, in my opinion? No investment advice. So let me walk you through briefly on the spreadsheet. I own every single one of these stocks. There is not one that I'm not invested in. And I did this for myself to know which one is the most valued, which one is the least valued. And so let me just walk you through a little bit on the spreadsheet. So first of all, this is the name of the company, right? So what I invest in. So you have energy revolution stocks, so Enphase and Tesla. I'm very much into Tesla electric cars and solar panels. I believe this is the future. This is inevitable. Then I have some miscellaneous disruptors. HIMS for healthcare, mostly preventative healthcare. Celsius as the energy drink disruptor, and Duolingo as a disruptor in the education field, so kind of unclassifiable. I've put these three together. Then I have my SaaS stocks. So I could have separated them among cybersecurity, seed-based, usage-based, but I just put them all together because I don't have that many here. So Datadog, Snowflake, Palantir, MongoDB, CrowdStrike, Zscaler, and Cloudflare. So these are all stocks that I own and love and believe they have wonderful fundamentals and wonderful business dynamics. Then e-commerce, right? Mercado Libre, the long time I've been a long time admirer of this company. I think it's a great stock. And Shopify I got into recently after it had an absolutely insane drop. I got into Shopify fairly recently. Then dLocal, I actually didn't sell dLocal after the short report, and they provided a really nice point-by-point rebuttal. So dLocal, I still own dLocal, and Square. I actually didn't put SoFi in there because it's more complicated to analyze as a bank, but Square as a major payments business, which fits well in this spreadsheet. So these are just the stocks that I've covered on the channel, and that are stocks. Not all of the stocks that I cover, I hope to add to this spreadsheet, but these are those that I've covered in the channel. So first of all, let's talk about the first row. So that's enterprise value. Why am I using enterprise value? Because I wanted a way to account for cash. A lot of these companies have a lot of cash on their balance sheet, and they have very little debt. And it's not fair. It wouldn't be fair to use market value. For these companies, enterprise value is actually a clearer picture of that company because it's oftentimes in favor of the company because they have much more cash than debt. So it's market cap plus total debt minus the cash. And since most of them are more cash than debt, what you'll find is that you're actually getting a discount if you buy it at market value, because really the cash needs to be removed. So there's like a built-in discount, and it's a better way, I think, to do the calculation. Then revenue. So revenue, we have trailing 12 months revenue. That way I don't have to adjust the spreadsheet quarter per quarter or year by year. I just look at the trailing 12 months. Then that's the revenue for the next 4 quarters. So we are lucky we're about to get Q4 coming up in this month and next month. So then it would fit nicely. We have 4 quarters, but depending on the time of the year, it's better to just say the next 4 quarters. And by the way, these are what I call my conservative estimates. And you could remove, I don't know, 10-20% of these estimates if you want to be ultra conservative, but it doesn't change that because this is a comparative spreadsheet. So as long as you get more conservative on all of them, the comparison would stand the same. I believe in all of these companies, and I'm bullish on all of these companies. I just try to answer which one is the most undervalued out of all of the companies that I'm bullish on. All right, next you have gross margin. So of course, gross margin goes up and down hopefully gross margin goes up over time for all of these companies, but you can't really predict the direction. Well, you could, but it would be too complicated for a summarizing video. So I just took the gross margin of the last quarter. And you can see this is going to have a big impact. All of these companies, in my opinion, are optimized for gross profit. So I'll be using gross profit, enterprise value to forward gross profit is what I'll be using to analyze these companies. So the estimated revenue growth, right, for the next the next 4 quarters, and then multiplied by the gross margin, and then you get your gross profit, your estimated gross profit that you're going to get for the next 4 quarters, and then you get the enterprise value over gross profit. So again, I think it's more accurate than market cap in this case, in the case of a lot of these companies. But you could use market cap and you wouldn't have that much of a difference. It just works more in our favor to use enterprise value here. Free cash flow to the firm, so that's unlevered free cash flow, and then I put enterprise value over free cash flow, and you know, free cash flow is I believe, in my opinion, perhaps the more important measure for more mature companies that are optimized for cash flow. I believe that's the best measure, because if you look at net income, you're going to have things like depreciation and amortization that are going to mess up the numbers. And we all know earnings, net income, is EBITDA even, is easier to be manipulated by CEOs than free cash flow. Free cash flow is much harder to manipulate, so I like free cash flow. And this is the spreadsheet for now, and I've color coded it, so feel free to pause. And by the way, I do believe for judging most of the stock, this is the most important row right here for judging most of these stocks, because I do believe that most of these stocks, for example, for enterprise value over free cash flow, they're early. Very early. Like, this number is going to go down as these companies grow. The free cash flow is going to expand. So I'm not entirely sure they're even optimized for that. But right now the market is so short term that they want to have a number on this kind of more accurate PE ratio. They want to have a number, and so you get a number here. But I'm not even sure. I don't think actually most of these companies are fully optimized for free cash flow. So to me, at least, what I'll base my decision to say which one is the most undervalued stock in my universe, I'll base my decision on enterprise value divided by forward gross profit. That's what I'll base my decision on. All right, so let me move on to a few slides now.
So now that I've presented the channel, the spreadsheet, sorry, let me show you a little bit the rankings. So the greener, of course, the lower the price and the most undervalued the stock is, and the redder, the less undervalued it is. Right, or overvalued, as some may say. And when I look at my ranking, well, not surprising. I've been saying this in a few videos so far. HIMSS is extremely cheap at 2.4 times enterprise value divided by forward gross profit. So very cheap, much cheaper than all of the other growth stocks, you know, compared to, like, say, a Snowflakes or a Enphase, like 10 times as cheap, which really tells me something's going on with HIMSS. The market has not noticed HIMSS, it seems to me. And free cash flow, I put soon here because they're probably going to be free cash flow positive next quarter, or at least that's what I'm hoping, but you can't really calculate it. It's negative for now, but it's so close. So as soon as that happens, maybe there will be a valuation reset for HIMSS. But I don't understand why HIMSS is so cheap. If you look at revenue growth next year, my estimate is 69%, gross margin 76%, so software-like margins. Really amazing business. I'm not an investment advisor, of course. Then Square, so Square is pretty cheap at 6 times, but much more expensive than HIMSS. And Palantir as well. So I find this interesting that in my coverage, the stocks that are like the most associated with either Cathie Wood or SPACs are those that are the lowest valuation. I find this very interesting. Palantir has a wonderful cash position. They're not going to go bankrupt. They're nowhere at risk of going bankrupt. bankrupt, and they're trading really, really inexpensively, albeit they have lower growth than most of the stocks in my coverage. Technically, Square and Palantir is like just 2% under my threshold of 30%, but you never know. It can go around 30% for a long while for these two companies. So I'm not too bothered by that. Mercado Libre 7.5, so that's again fairly inexpensive. Duolingo, same, fairly inexpensive, and CrowdStrike, MongoDB, Zscaler, and you can look at the spreadsheet. And then we get into more expensive the SaaS stocks, right? So the more you get into the SaaS, the more expensive it is per traditional valuation metrics. But that's okay, because these companies have wonderful economics and really large growth runway in front of them. Then we get really quickly to Tesla. So Tesla actually is fairly expensive per that metric, but it is less expensive if you look at the enterprise value over free cash flow. It's actually less expensive than a lot of the stocks, and even close to valuation to some of the stocks that are not expensive by EV over forward gross profit metric. But again, it's all about the growth rate and the size of the growth runway. Celsius more expensive, Snowflake and Enphase then fully in the red as far as valuation goes in my spreadsheet here. But I just wanted to quickly do a comparison of some of these metrics with, say, an established company. So for example, I did it for Apple. I could have done it for a lot of more established, very low growth companies out there. Apple story is all about the buybacks. They've been buying back stock a lot, but nonetheless, they're only growing revenue at 5% a year. Gross margin is absolutely stunning for a hardware business. Hopefully this is the kind of gross margin that Tesla is going to get 10 years from now. This is an amazing gross margin for a hardware-based business. But if you apply all of this, you're trading at 11 times forward gross profit. So again, in my ranking, that would be somewhere right here. That'd be right here. So as you see, there's companies that are undervalued compared to Apple, and some that are overvalued compared to Apple. And the enterprise value to free cash flow, it's lower at a 22, but you see there's companies that are high growth but have lower than that. Like if I look at my coverage, dLocal is cheaper than Apple on an enterprise value to free cash flow basis, but dLocal is a company growing at 60% a year its revenue. So again, it all depends which valuation metric you take or not. But I just created this spreadsheet so that you can pause on the video and have an idea out of all of the stocks that I cover, which one would be traditionally considered cheap and which one would be traditionally relatively considered less cheap. I do believe that all of these businesses have tremendous growth runway, right? They have a total addressable market that could be a decade or more, and so these businesses will grow into their valuation. But again, some of them are cheaper than others, and hopefully you can make a choice if you're interested in investing in any of these companies. Again, not investment advice. None of this has been investment advice. This is just entertainment. Thank you so much for watching. Please like and subscribe. It takes me a while to do these videos, so I really appreciate if you can subscribe and help me out. Thank you very much, and have a great day. Thank you.